What if I told you that the entire global financial system relies on an ancient, rusty machine that is currently burning billions of dollars in hidden fees every single day? It sounds crazy, right? But the traditional banking system is facing a massive problem, and a giant wave of capital is quietly preparing to shift into digital assets. We are looking at some mind blowing data that dropped on May 28, 2026 about the foreign exchange market, or more commonly known as the FX market. This isn't just a big financial market, it is the absolute king of all financial markets, turning over a staggering $7.5 trillion every single day, according to the Bank for International Settlements. When you annualize that number, it reaches a mind melting $2.7 quadrillion per year. A prominent crypto researcher right here named Smoke recently shared a viral post on X that highlights exactly how Ripple has positioned itself to take over this massive space. We aren't talking about future theories anymore. We are talking about concrete corporate data showing that Ripple now covers 90% of the global foreign exchange markets. So let's break down exactly how this system works, how XRP fits perfectly into the model, and my personal take on what this means for your portfolio. But before that, let's check our daily chart time frame here for XRP. As we can see, the current price of XRP is playing at a price of 1.3147. Yesterday's candle is bullish with an attempt to go back above our major resistance right here at 1.3211. But as we can see, the body closed just below it, which shows that it failed to go back above our resistance right here. So this means we have a very strong resistance right now that even our current candlestick seems to be struggling to pass through or to break above. Now let's go back to our news. Now let's try to talk about the $7.5 trillion daily market that forced to change. To understand why this is such a massive deal for XRP, we have to look at the massive headache global banks face every day. Right now, when the banks want to move money across borders, they can't just press a button and have it arrive instantly. They have to use an incredibly slow network or pre-funded accounts scattered across the globe. And these are known as the Nostro and Vostro accounts. This means billions of dollars of bank capital are just sitting idle in foreign vaults, doing absolutely nothing except absorbing risk and waiting to settle transactions. On top of that, banks face massive costs across multiple structural categories every single day. They have to deal with heavy foreign exchange spreads, expensive currency hedging to protect against sudden price shifts, complex treasury operations, operational liquidity blockages, and strict Basel III regulatory compliance rules. It is an expensive, slow, and outdated way to move money. So in my own opinion, the traditional banking layout is completely broken for the modern world. In an era where you can send a high-definition video across the ocean in a fraction of a second, it makes sense. It makes zero sense that moving money takes 3 to 5 days for it to complete. The bank know this infrastructure is draining their profits. They aren't looking at crypto because they like the technology, but they are looking at it because they desperately need to cut these massive operational costs. This friction is exactly what creates the multi-trillion-dollar opportunity for a frictionless utility asset. Alright, so how does Ripple already cover 90% of the global FX market. Let's highlight this part. This is where the data from the post shared by Smoke becomes truly mind-blowing. Ripple Payments, the network formerly known as RippleNet, isn't just a small pilot project anymore. The network has already processed over 27 million lifetime transactions, totaling more than $50 billion in total value. It holds multiple global payment licenses, operates actively across 55 countries, and its payout infrastructure reaches over 80 destinations worldwide. But the single statistic that sent shockwaves through the community is the 90% coverage metric, sourced directly from Ripple's internal corporate announcements via FXC intelligence. This means that Ripple's payment corridors are already physically connected to 90% of the global foreign exchange market's currency volume. The highway has already been paved, the lanes are open, and the banks are already lined up at the entrance. This 90% coverage figure completely shatters the argument that Ripple is just an experimental software company. Building a compliant, licensed global financial network that touches 90% of the FX market takes years of intense legal work, regulatory auditing, and relationship building. You can't just copy and paste this kind of infrastructure. So in my view, Ripple has quietly built a massive competitive moat while the retail market was busy arguing over daily price charts. The pipes are laid, and now they are ready to turn on the main valve. So what is the documented requirement for banks to hold? Now let's get into the absolute core of the mechanism, the part that directly impacts the digital asset itself. Many critics have argued for years that banks might use Ripple's software without ever touching XRP. But Ripple's own published research and official documentation completely debunk that myth. When a bank utilizes this network to eliminate their expensive foreign exchange cost, the official documentation explicitly outlines two models. The spread can either exist between traditional fiat currencies, or it can move directly between fiat currency and XRP held directly on the bank's balance sheet. The documentation explicitly states when XRP is used, the model assumes that banks hold XRP on their balance sheets and provide their own liquidity for FX transactions. This is an absolute game changer. It means that for a financial institution to unlock the maximum cost savings of this network and eliminate their foreign currency hedging risk, they are required to hold XRP as a core balance sheet asset. So in my own personal opinion, this is the ultimate smoking gun for utility, for long-term utility. This isn't speculation for a random forum. This is a documented corporate protocol from Ripple. If banks are holding XRP on their balance sheets to settle trillion-dollar cross-border flows, they cannot afford to hold a tiny amount. They need massive, deep liquidity pools to ensure their transactions don't cause massive price slippage. This structural demand completely changes the velocity of the asset, moving it from a speculative trading token to a highly guarded institutional reserve asset. So, how will institutional balance sheets change the demand dynamic? When a major bank decides to add a digital asset to its balance sheet, the purchasing power behavior is completely different from a retail trader. They don't log onto an exchange and buy with a market order. They accumulate large blocks through institutional liquidity providers. lock the assets away in institutional-grade custody vaults and hold them for long-term operational utility. Because the foreign exchange market moves at a scale of $7.5 trillion every single day, even a tiny fraction of that volume migrating onto the XRP ledger would create an unprecedented supply shock. If a bank needs to facilitate hundreds of millions of dollars in daily cross-border payments between diverse fiat pairs like euros, Japanese yen, or Turkish lira, they must maintain a substantial permanent balance of the bridge asset to keep their payment corridors fully liquid and operational at all times. In my own opinion, the transition of an asset to corporate and institutional balance sheets is the highest form of adoption possible in the financial world. When institutions hold an asset for operational utility rather than speculative resale, they effectively remove that supply from the open market. This creates a powerful baseline demand that doesn't care about market sentiment, fear, or retail panic. The asset becomes a permanent cog in the global financial machine, and that permanent utility is what ultimately drives long-term structural value. Finally, we have our conclusion right here, where when you connect all these pieces together, an incredibly clear picture will begin to emerge. The foreign exchange market is the largest financial arena on earth, turning over an annual value of $2.7 quadrillion while drowning in legacy inefficiencies. Ripple has systemically spent years building a compliant, highly licensed infrastructure that now covers 90% of that global market. Most importantly, Ripple's official framework clearly states that the ultimate destination for this system involves financial institutions holding XRP directly on their balance sheets to manage their own liquidity and eliminate legacy friction. The scale of the FX market is so incomprehensibly massive that even Ripple captures just a single-digit percentage of this global volume. The resulting institutional demand for XRP would be unlike anything the digital asset space has ever witnessed. The foundations are firmly set, the corporate architecture is fully documented, and the migration of global finance onto digital rails is steadily unfolding right before our eyes. And this finally ends our video. Thank you very much for watching, and you might as well want to check this next recommended video right here.